All right, senor. Part 4, here we go. Yes, I trimmed this morning. I had my first insult this weekend. And it wasn't intended. See, I hadn't cut my hair for a few days, and I was asked if those boys were my sons or my grandsons. So I went home and cut my hair. This is why I go bald, man.
You should show a picture of Jared.
I might one day feel like it should be like, I just grow it out, just do that old look.
No.
Yeah, just change of personality.
No, definitely not.
Hello and welcome to episode 19 of the Move It podcast with me, Jared Urain, and...
My name's Isaac.
And we're with the 5 Diamond Group here at Vice Realty. Before we get started, we just want to give you a short and quick reminder for the YouTube algorithms. If you do like our content, you do appreciate it. We are grateful and we are thankful for your graciousness. So please feel free to share that with someone you think might find the content valuable. And if you like it so much you want to subscribe, well, we'd appreciate that as well.
Actually, do us a favor. Even if you don't like it, just keep watching it.
Yeah.
Just put it on mute. Just keep letting it
Roll back a couple times.
Yeah, just to help us out.
That'd be cool, right? We're actually making good progress. We're seeing so much improvement in our first 20 episodes. We are finally settling in to our what we call habit, and I'd like to take a moment to acknowledge a special man in our lives. He really has grown on us.
Thank you. I appreciate you.
Lex.
Oh. Oh. Okay.
No, definitely. We've definitely seen the quality in our production level, and as you can see, our media brand of the 5 Diamond Media Group is all due to the man behind the scenes, Lex Guerrero. We'll have more on that in a little bit, but if you want to find us and follow us to be aware of any of these episode updates as they come along, feel free to catch us on any of the social outlets, as well as the reminder bell. And like Isaac said, just play it in the background if you wanted to. We would totally appreciate it. Lex, here goes the intro. Welcome to episode 19 of the Move It podcast here at Vice Realty. My name is Jared Urain. My business partner, guest, and friend Isaac Ordonez is with me on this part 4 of July's special economic breakdown. Just to recap, why this month we're focusing on the economy is because we find this particular month is going to be a pivotal month in history when we look back and we see, okay, where was the moment in transition? The Fed is fighting inflation. Rates are kind of juggling around the 7s. Our inventory has been going up and down, and we bounced from the bottom of a price drop and now have come halfway back up here in Las Vegas with our median price point landing around $442 at the moment. So we're going to see a transition definitely for the next couple of quarters. It's not volatile. We're not headed towards a crash, but there is a transitory moment that's happening right now. And we totally want to be aware of that and help you get the information that makes sense in today's marketplace. So Isaac, we've had so many different conversations with so many different clients, so many fun things that have been happening lately, especially here in the business for us. We've seen the hype of 2021, and this year has been surprisingly awesome.
No, it's been great.
I mean, we did our forecast at the beginning of the year with all of the chaos that was happening, basically the fallout of a rate hike, a price hike by mortgage rates from last year, which kind of shell-shocked everybody. But, I mean, when we did our forecast, we did not anticipate the year being this good as it did, to be honest.
Well, there was a lot of uncertainty as far as how high rates we're going to get.
Right.
There was speculation of 9%, 8%, and I think we got really close to the 8%, but I don't think we saw it past that. So
it was like it was almost there, but then just kind of backed off for a minute.
And a lot has to do with inflation kind of cooling off, and that's a great thing. So
yeah. And so with that, with those thoughts in mind, there's a couple of key subjects that we're going to cover today. Specifically, we're going to address the conversation that many people have been waiting for the years. Where is the foreclosure crash? Where's this glut of inventory? Well, we want to make sure that we put that to rest and clarify the information of what you are hearing, because you're going to hear these in the news. We want to make sure that you have the right perspective in there. We're also going to talk about what the current state of the real estate industry looks like and what we can take away, what you can look forward to in this year. And then we also have, we're going to wrap it up with what makes a good agent, because Isaac's got an interesting story that he's going to share with us as to what has happened here locally and how you can get yourself in a better position to be prepared. So to start it off with, we're going to cover the foreclosure market space. For the first half of 2023, there has been an increase in foreclosure activity. We're seeing a lot of headlines cover that. But to put it in perspective, this is not the same announcement that you may have heard 15, 14 years ago, just before the Great Recession. Now, Isaac was still in high school at that time. We're wrapping it up. You were out.
I was already out.
You were in the working world.
Yeah.
You were an adult at that time. But you got to experience that.
Not that young.
Wasn't I know. But just because foreclosures, you hear this in the news cycle, just because there is an increase in foreclosure activity does not mean we are headed towards a crash. Why? Well, a lot of it has to do with just the pure numbers and difference. We are talking hundreds of thousands of numbers, and you might hear 200% increase, but you have to put it in perspective from when? A year ago, right? And a year ago, we were wrapping up the pandemic and getting out of it, and they were just letting go of some of the other ones that were in moratoriums. Even during the height of the pandemic, there was just over 1.2 million homes that went into some sort of management with the banks. That, when you compare that to 2008 and 2009, we're talking 9 and 10 million units. It's a fraction, just a fraction, even at the height of the pandemic of what was going on. So now what we're dealing with now is many of the foreclosures that we're seeing today have been put off, and now they're finally actually hitting the marketplace. We have friends as well as clients who are wholesalers, and they've seen an increase in activity. Would you say?
Yeah, I agree. And one thing to keep in mind for our viewers, our listeners, is the news is always going to make sure that the headline is super, super attractive, like clickbait, right?
Yeah. Negative.
Well,
it's hard to find a clickbait that's good, positive.
That's true, right? So regardless, negative or positive, it's at the end of the day, they have to get your attention.
Right.
So one thing to keep in mind is that numbers that we're talking about include actual foreclosures, homes that have actually been foreclosed by the bank, that have been repossessed. Then you have notice of default, which is just a little notice to the homeowner who might be behind, who might, this even includes military, because military has a provision that if they're serving out of the country and they can't make the payment, they can file a document to, avoid the foreclosure, right?
Right.
But at the end of the day, a notice of default can be submitted or on accident or purposefully. And then you have just like any other bank auctions or anything like that. So you have a multitude of numbers here, so it's not just one thing.
Different stages.
And a lot of these notice of defaults are going to come out of that notice of default, because once they catch up or they make a modification, anybody who's trying to make or do a modification typically has to go through the process of not paying and show some type of hardship to be able to get that modification. So you got a property that's sitting there for 6-9 months not being paid for, with the notice of default, it's going to reflect in these numbers. But if they get the modification approved or they sell in time, then that property doesn't go into foreclosure. So even though we're looking, probably, at 100, almost shy of 200,000 units in these statuses, a lot of those aren't actually going to get foreclosed on.
Right. So just to recap, the spectrum of foreclosures, the number of units that we're talking about is about 186,000 from a notice of default. Now that's somebody who hasn't made a payment in like 3 months, 2 months. And that's because that was the last payment that they made. Notice of default is the first stage of foreclosure. And then there are 2 more stages before you can actually have the bank own the property, because they have legally filed the process. And during those periods of time, the homeowner can fight the process, slow the process down, drag the process out. In order for the bank to own it, that would then be They actually scheduled the auction, and then you have the bank repossession portion of that whole series of numbers, 186,000 units at the moment, nationwide. 186,000, a fraction of the millions and millions that were happening 15 years ago. So the pure scale of numbers is vastly different than what was the Great Recession. We are not headed towards any sort of crash because item number 2, inventory. The contrast of inventory from 2008 and 2009 to today is a world of difference. There is no comparison between the two. In 2008 and 2009, there was easily 12 months inventory anywhere in the country. 12 months. It took a year to sell a home. And that's why it took 2 years for home values to drop from where they were. Like here in Las Vegas, it was 306 was the median in 2006. And it dropped down to like 120 or 150 or something like that over the course of 3 and 4 years. And that was because you had so much inventory and then so many people walking away. And as it just continued, it created this mudslide of inventory. Today, we are still under 2 months for our single family homes. And we have a median price point that's over 440,000 at the moment. So a world of difference. You add to the fact that our rates are probably the same as it was in 2006 and 7. But we need more homes to sell. And that's because most people have locked in a good rate.
And
a little scared.
Those are great facts to know, especially if you or anybody you know is in that process of possibly foreclosing or not paying for whatever reason, hardship, unemployment, whatever the case may be. But 2 things to keep in mind is that because of the way the market is, if you're just slightly underwater, you're more than likely probably going to get multiple offers, especially if you're in a lower price point, where you might be able to break even, where it doesn't affect your credit. Yeah. Maybe you don't walk out with any money, but at least you're not hurting your credit.
That's right.
And it's easier to recuperate from that than having to wait, the time frame. But 2, one of the biggest misconceptions is that once somebody's behind, it goes into foreclosure, the homeowner still has the ability to claim that equity. So let's say somebody, went through a hardship, didn't pay for a year, got foreclosed on, but had $100,000 in equity. Yes. They can actually go back and file for that equity back. And so those are things that keep in mind. So educating and informing yourself, getting with one of us to see what those options are, to maybe possibly just selling, cashing out, and helping you get back on track.
And that highlights the other 2 points. First, the equity position for a lot of homeowners is positive. I mean, you might be behind on your note, but you more than likely have equity. Very few homes today owe more than the home's value.
Is it like over 60% own their home, own less than 50, or owe less than 50%?
Correct.
And the majority of those own their home free and clear. And so there's, even if you're late on taxes, insurance, HOA, all that stuff, pretty sure that you still would walk away, or there's other options to be able to help you out. And so knowing all your options, again, informing yourself, getting with one of us to be able to help you navigate that, it's going to be very key so you guys can make the right decision.
And the last point as to why this period of time is very different than 2008 is the quality of buyers that have bought over the last 12 to 14 years is very different than it was pre-2007 and 2006. Leading into those years of the Great Recession, people were buying on speculation. People bought homes that didn't truly qualify. There were loan programs that allowed them to purchase homes in that environment and in space. Since then, post-recession, since the early 2011-12s, everybody that has purchased a home qualified to own their home, for one. For 2, everybody that purchased free 22 for that matter, has a great rate and more than likely has a lot of good equity in the home. So their buying position, as well as their affordability, their quality of buyers is smart. It's savvy, and they will more than likely be able to sell with positive. So,
and even the sellers that are buying, majority of them are putting a lot of money down to keeping their payment affordable.
That's right.
So they're also walking into a good, equity position on their new homes. And so regardless, any way you see it, the majority of these buyers are going to be strong buyers.
Yep.
And the likelihood of an actual recession where it includes an influx of foreclosures is very, very unlikely.
Exactly. And that's another supporting reason why home prices might fluctuate, but we aren't headed back. In my opinion, here in Las Vegas, I don't see us going back under 400,000 for a very long time.
Yep. Yeah. Or ever.
That's a possibility too. You never know. But if nothing else, we are definitely in a different world. In the sense financially, we're definitely in a different space. And as inflation starts settling down, there was a report that came out last week where the affordability of people, not just in real estate, but also in their income is increased. So we're seeing that transition happen at the moment. And I feel like next year is going to be a different ballgame altogether than what everybody was scared of. So those are my 2 cents on the foreclosure and the current update on that. Anything to add there, Isaac?
No, I think you covered it all.
So that takes us to our sponsor. If you've liked the quality of and as the improvement of what we have done here at the 5 Diamond Group in our Move It podcast, you can thank Lex Guerrero, Lex Get Raw, and our 5 Diamond Media Group package. If you are an agent and are thinking about or have a client that would like to be able to sell, we encourage you to take a look at 5dgmedia.com, right? 5DG Media.
Keep it simple. Keep it simple.
If you're an agent and you've got a listing, take a look at 5dgmedia.com. Mention this video and we'll give you a discount on any of the packages that we've got available for you, whether it's property photos or reels or your own personal marketing package. Take a look at 5dgmedia.com today. We look forward to working with you tomorrow. With all of the transition that's taking place right now, there is some positive forecasts that we can take a look at in today's marketplace, especially here in real estate. Because our inventory has been limited for the first half of the year, home prices have gone up. But we have reached the peak of our summer activity, and typically our cycle will trend down. Whether it's price point, inventory, we should see more inventory growing over the next couple of months. And that's a good thing for buyers because then you get more options. Rates are expected to stay around 7%, as long as the Fed does what they expect to do, which is raise their rate 1 or 2 more times. That said, unless something else contributes to those changes, then that would be the only reason why we see rates go higher and maybe slow things down. But the forecast means that we are looking at a good positive step forward in the real estate market here locally. We would like to see more inventory. That should keep home prices where they are at through the end of the year. That makes it consistently accessible for most people that are thinking about buying or selling. And that means it makes it more predictable for buyers and sellers to really understand how they can make that move, either to sell their home and purchase or buy their first home, whichever fits for you. That also means that we have a more realistic forecast on mortgage rates. As long as rates stay around 7%, then we're going to be in a normal market. And if you put it in context of what it was like in the 80s.
Did you see normal market?
Normal market, man. This is where we're at.
I think it's hard for people to wrap their head around, normal, because we haven't had normal in
10 years, 15
years. Yeah. And so I think people see 7%, 6%. When I got into the business, most of my clients were probably getting 5.5%. Mm-hmm. And that was normal, and if they got any type of down payment assistance, rates would go up 1%. So they were getting 6.5%, but that was normal. Mm-hmm. And so I think, when anybody who lived through like my age, saw the recession, saw what happened, then they kind of have that like in the back of their head.
With 2, 3, 4%. 5%,
right.
Yeah.
Well, they think like foreclosures, they think of, buying homes for $80,000, and so that wasn't normal. And then moving forward, prices started climbing because we needed to get back to normality. And then all of a sudden, a pandemic it hits us. So I don't think we've had a normal market. So,
and that's fair.
So I think you were going to talk a little bit about mortgage rates in the 70s, 80s.
Right. Yes. I mean, when we put it in perspective of in the context of history. Rates have been tracked since early 70s, and going into the 80s, that's where we saw the peak of mortgage activity. It was typically around 9 to 14% throughout the 80s, and the peak The highest ever was 18.4% in 1981. I mean, that's 1.5 more times than what we're currently dealing with.
And so you got a lot of people are like, well, yeah, in the 80s, homes were 150,000. True,
then,
but then you were paying 18% interest rate, right? And so everything kind of just balances out, right? Yeah, you were paying less for a home, but you were also paying higher for rates. And so right now, we're still technically pretty low on the rates.
Mm-hmm. In addition, the income level for most people is vastly different than it was in the early 80s. And so people are making a lot more money. And when you put that in correlation to what their affordability is, it's about the same as what it was back in the 80s. So we're not seeing that affect too much as long as we stay around the 7s.
And when you talk about wages, one thing that I always think about is that growing up, like when I was in elementary, you were taught like college, university, right? You had to get a degree if you wanted to make good money, because that had been the case for the past 70 years, right? If you didn't have a degree, if you weren't a doctor, an attorney, somebody like that with a specific career,
or work with some company for 25 years,
or that, right? You weren't going to make a good money, and so you had a working class and a professional class. Now it's just so easy to create wealth because you don't need college, you don't need a degree to go and make money. You can easily make 6 figures doing entrepreneurship, right?
Sorts of things you can do.
You have different entrepreneurs that started by flipping couches and making $3,000 to $5,000 a week, just flipping couches. Or you had other people doing different things. Now it's so easy to make money that really nothing really prevents you from making more money than yourself.
It's what's in demand. If you're an HVAC technician in Las Vegas, there's no reason why you're not making 6 figures.
Yeah.
If it just depends on where you're at, what you're doing, pick your market, and you can easily make money in business. Absolutely. And with that said, it just means that affordability is accessible for many folks. Now, there are definitely a segment of the population that don't have those luxuries, or maybe don't have opportunities in that sense, but we can make them. We can help. You can help yourself through the technology that we have today. The forecast for rates at this time, many forecasters are saying that at the end of 2023, we're going to see rates go down below 6%. And in my opinion, it just doesn't seem like that's a logical statement to say. It's hopeful, but the truth is I feel like that's going to be more 2024, which I think is going to contribute to an awesome year next year. And so we'll take a look and see what that looks like. But either way, at the moment, the way everything is trending, everything is looking positive in the sense where inflation is going down, and we should see everything iron out on it. And add to that, the final point is that there's so many folks with so much equity, as you mentioned, 60% of the nation with 50% or more equity in their homes. There's just so much opportunity for homeowners to take advantage of today's marketplace. And when it comes to being able to sell, we want to make sure that you get the right information the first time. So here at the 5 Diamond Group, our job is to take care of you and your unique circumstances. That does bring up the last part of our segment. What makes a good agent?
So I was just reading an article about a lady in North Las Vegas lost her husband, and she was ready to sell, right? And she just wanted an easy transaction, so she called. She got a letter from a cash buyer, like an investor group.
One of those ones that you see all the time.
Yeah, all the time.
Okay.
And, somebody goes out to her house, offers her $270,000 for her house, 14-day close. And she's like, okay, take it. Calls her husband, her son, ecstatic about the offer, and he's like, no, your house is worth way more. So she ends up listing it with an agent, for $370,000, gets an offer for $372,500, accepts it. So over $100,000 more than the initial offer, right? And so she had canceled that previous offer or the previous contract, but then all of a sudden, the escrow company gets a contract. And so she has to go through these legal actions and legal loopholes to be able to get out of that original contract, all because she did not reach out to an agent the first time. And one of the biggest misconceptions that I see or that I hear is, well, I'm good with people. I'm great with people. I would make a great agent. Your job is easy. You guys make a lot of money. It's so easy money. The truth is, being good with people is just part of being a great agent. It really comes down to the motive, right? Because I know some cash buyers, some investors that we work with, and I love working with them because they're very ethical, they're very honest. They're trying to, they have a good motivation, a good why, to a good purpose as to why they're doing what they're doing, right? And so it's very important for you to get matched up to an agent who's not just there to make money, it's easy money, that thinks that is just, another transaction or another number, that actually cares about your best interest, because that is part of our duties. It says that we have to look out on your best interest. Yeah.
And so the intent of the agent, the purpose, their why, the agent's why are they in business is a critical factor in our opinion. And that's one of the things that not only do we teach our agents, but we live by. What the purpose of why we're here is to be able to help you as a homeowner make the best decision for you and your family. We understand what all of your options are, and we'll help you reach those goals, whichever way it is. And the intent there is to ensure that you get the right information the first time. It's our kind of logo there.
Just 15,000 agents. Most of them are probably going to be exiting the market here soon. We'll get new ones, right? But I've only ran into a handful of them that I can actually trust and actually appreciate what they're doing, and actually kind of, admire them for what they're doing, because they actually truly care about the agents. And then we work with some where we're like, man, I don't know how this person is in business, because they obviously do not care about their client. And that's sad to see.
So the market is changing, and so is the quality of agents. You have an opportunity to be able to interview the agent and identify yourself with who is someone who's going to be able to take care of you and your family. Our goal is to make sure that you get a good relationship and a good experience, and we'd love to be able to have an opportunity to talk with you down the road.
This is the Move It podcast with Isaac and
me, Jared. So thank you so much for tuning in to this episode 19 of the Move It podcast here at the 5 Diamond Group. My name is Jared Urain.
My name is Isaac
Ordonez. Thank you so much for enjoying this episode. Please feel free to share, like, and subscribe. And again, big shout out to our sponsor, and thank you to Lex Guerrero at the 5 Diamond Media Group. Check out 5 Diamond or 5dgmedia.com for access to all of the pricing programs on different media packages that you can use for you and your business. If you're looking to buy or sell a home, it's the 5diamondgroup.vegas. My name is Jared. This is Isaac. Until next time, be cool, man. It's stinking hot out there.
It is.
And be like a butterfly.